In every financial cycle, there is a moment of confusion when headlines shout, "Sirach," and emotions take control. Silver falling to $75 looks like fear, panic, weakness. But professionals know this phase well. It's when liquidity disappears, volumes thin out, and prices are pushed down not by reality, but by strategy. This is the week when markets look empty, but decisions are being made that will define the next decade. Now focus here. China paying $89 is not generosity, it is intelligence. Nations don't buy metals emotionally, they buy them strategically. When a global power pays a premium, it tells you one thing: silver is not being valued as a trade, but as an asset, a weapon, a reserve. The paper price collapses, while the physical price tells a completely different story. And that gap is where wealth transfers hands. This is the ghost week trap. Retail investors see falling prices and step back. Weak hands sell. Strong hands stay silent. Institutions accumulate quietly while the public argues on social media. History proves this pattern again and again. Gold, oil, currencies, even real estate. The biggest moves are prepared during the quietest weeks, when confidence is lowest and clarity is rare. Understand this mindset: shift. Price is temporary, value is permanent. When silver is attacked on paper markets, it creates an illusion of oversupply. But when physical demand rises at higher prices, it exposes the truth: scarcity. China is not chasing discounts, it is securing the future. And those who learn to read this signal stop reacting and start positioning. This is where mindset separates winners from spectators. The market doesn't reward those who follow fear, it rewards those who follow data, discipline, and patience. When everyone is looking at 75, you must ask, who is paying 89 and why? Because fortunes are never built at the top of excitement, they are built at the bottom of doubt. When silver appears to crash to $75 on screens, while large buyers are simultaneously paying 89, the first instinct of the crowd is to assume error or manipulation. In reality, this divergence between paper price and physical price is not an anomaly. It is a structural feature of modern commodity markets. The price most investors see is derived from futures contracts, leverage positions, and algorithmic trading, not from the immediate exchange of real metal. That distinction is critical because it explains how silver can look weak in headlines while becoming more valuable where it truly matters. The hook is simple but uncomfortable. The market price you trust may not represent the asset you think you own. Paper markets are designed for speed, liquidity, and speculation. A single ounce of physical silver can be traded dozens of times on paper within seconds, creating the illusion of abundance. When selling pressure hits these contracts, prices can fall sharply without a single additional ounce entering the real supply chain. This is where perception is shaped. Traders react to charts, not cargo. Fear spreads quickly, stops are triggered, and the narrative of a crash is born. Yet underneath this noise, physical buyers operate on a completely different framework, one based on availability, logistics, and strategic necessity. The hook here is powerful. A falling paper price does not automatically mean falling value. Physical markets tell a slower but more honest story. When buyers are willing to pay a premium above spot, they are signaling scarcity, not weakness. Premiums emerge when immediate delivery matters more than theoretical future supply. Industrial users, sovereign entities, and long-term holders are not chasing momentum. They are securing resources. If silver were truly abundant and overvalued, premiums would collapse, not expand. This disconnect exposes a truth most investors miss. Paper prices can be influenced, but physical demand must be satisfied. The hook becomes unavoidable. Someone is paying more because they know something time-based traders cannot afford to wait for. This divergence also reveals how wealth shifts during moments of confusion. Retail participants often anchor to visible prices and react emotionally, while informed buyers focus on replacement cost and future utility. When paper prices drop, it reduces headline risk, allowing large buyers to accumulate without competition. The market rewards patience, not panic. The most dangerous mistake is assuming the screen tells the whole story. In reality, it only shows where fear is concentrated. Value, on the other hand, is being negotiated quietly at higher prices by those who understand that when paper and physical disagree, history tends to side with what can be held, shipped, and stored. Ghost Week liquidity is one of the most misunderstood forces in financial markets, yet it repeatedly shapes some of the most deceptive price moves investors ever witness. These periods occur when participation thins out, holidays, transition weeks between reporting cycles, or moments when major players deliberately step back from visible activity. On the surface, markets appear calm or directionless, but beneath that stillness lies heightened vulnerability. The hook is simple and unsettling. When fewer participants are present, prices become easier to push, not more accurate. Liquidity is the oxygen of price discovery. When it dries up, even modest trades can create exaggerated moves. During Ghost Week conditions, order books are shallow, bid-ask spreads widen, and algorithms dominate the flow. A sell order that would normally be absorbed without consequence suddenly sends prices sharply lower. This is not because fundamentals have changed, but because the market's ability to resist pressure has weakened. The visual impact is dramatic: steep drops, broken technical levels, and alarming headlines, while the underlying economic reality remains largely unchanged. The hook here is critical volatility during low liquidity often reflects absence, not information. Professional operators understand this dynamic and plan around it. They know that price declines in thin markets can manufacture fear without requiring large capital commitments. By allowing prices to slide during these windows, sentiment is damaged efficiently. Retail participants interpret the move as confirmation of weakness and step aside or sell, reinforcing the decline. Yet this reaction is precisely what sophisticated buyers anticipate. Ghost Week is not about aggressive accumulation. It is about preparing the environment where accumulation can occur later, quietly and at better terms. The hook becomes uncomfortable. The market is not moving against you. It is testing your patience. From an economic perspective, Ghost Week liquidity distortions reveal the difference between transactional price and equilibrium value. True value emerges when buyers and sellers are both present in force. In their absence, prices become signals of imbalance rather than judgment. Central banks, industrial consumers, and long-horizon investors are acutely aware of this distinction. They do not reprice assets based on thin trading weeks. They observe behavior, flows, and delivery conditions. When prices fall during low liquidity periods without corresponding changes in demand or supply, it creates an information asymmetry. The visible market screams danger while the invisible market remains steady. The real risk lies not in the temporary distortion, but in misinterpreting it. Investors who confuse low liquidity volatility with structural weakness often exit positions at precisely the wrong moment. Ghost Week turns uncertainty into a tool, transferring assets from reactive hands to disciplined ones. The most powerful insight is this: when liquidity disappears, prices speak louder but say less, and those who understand this language stop reacting to noise and start recognizing opportunity. When a nation-state steps into the market as a buyer, the logic shifts immediately from profit to power. Strategic accumulation by governments is not driven by quarterly returns or technical indicators. It is driven by security, leverage, and long-term control over critical resources. This is where many market participants lose the plot. They watch prices fluctuate daily while states focus on decades. The hook is striking: governments do not speculate, they position. China paying a premium for silver is not an emotional response to market volatility. It is a calculated move rooted in industrial planning and monetary strategy. Silver is essential for energy transition technologies, advanced electronics, and defense applications. When a state secures supply, it is not reacting to today's price, but protecting tomorrow's production. Paying 89 while the screen flashes 75 signals urgency about availability, not concern about cost. The hook becomes clear: price sensitivity disappears when strategic necessity takes over. Unlike private investors, nation-states operate under a different risk framework. Inflation, currency devaluation, and geopolitical fragmentation are not abstract theories to them, they are operational realities. Hard assets like silver function as both industrial inputs and monetary hedges. Accumulating them reduces dependence on foreign supply chains and paper-based financial systems. This behavior often intensifies during periods of apparent market weakness because falling prices lower political visibility while increasing strategic advantage. The hook here is subtle but powerful. The best time for a state to buy is when the public believes the asset no longer matters. Strategic accumulation also reveals an imbalance of information. Governments have access to demand forecasts, industrial capacity data, and supply constraints that are not immediately reflected in market prices. When they act, it is usually ahead of visible shortages, not after them. By the time scarcity becomes obvious to the broader market, accumulation has already occurred. This creates a delayed realization effect, where prices adjust suddenly after long periods of indifference. The hook is uncomfortable. By the time the story becomes mainstream, the opportunity phase is already over. What truly differentiates state-level buyers is patience. They do not need validation from markets to continue accumulating. They can withstand volatility, negative sentiment, and temporary drawdowns without changing course. This patience allows them to absorb supply during moments of confusion, especially when other participants are distracted by short-term noise. When a government pays above spot, it is sending a signal without issuing a statement. The message is not about today's chart, it is about tomorrow's balance of power. Wealth transfer in financial markets rarely happens during moments of optimism. It happens during periods of stress, confusion, and emotional exhaustion. When prices fall sharply, the narrative quickly shifts from opportunity to survival, and that psychological shift is where the transfer begins. Institutions understand this dynamic deeply. They do not chase rising prices, they wait for forced selling. The hook is uncomfortable, but real markets are designed to move assets from the impatient to the disciplined. During price suppression phases, selling pressure is often driven less by fundamentals and more by leverage. Retail participants are typically exposed through margin, derivatives, or emotionally concentrated positions. When prices drop, margin calls and fear-based exits accelerate the decline. This selling is not strategic, it is reactive. Institutions, on the other hand, operate with longer time horizons and stronger balance sheets. They are not forced to sell into weakness. They are prepared to absorb it. The hook here is simple and sharp. Forced sellers create voluntary buyers. These phases are often misunderstood as signs of structural failure. Headlines amplify negativity, analysts downgrade forecasts, and social sentiment turns decisively bearish. Yet this environment is precisely what large players wait for. Lower prices reduce acquisition cost, negative sentiment reduces competition, and volatility discourages speculative capital. This is not accidental, it is cyclical. Every major accumulation phase in history has been disguised as a breakdown. The hook becomes clear. What looks like collapse to one group looks like clearance to another. The mechanism of wealth transfer is subtle but powerful. Retail exits lock in losses, while institutional entries establish future upside. Because institutions scale and gradually, their activity rarely produces immediate price recovery. This absence of confirmation reinforces doubt among those watching from the sidelines. By the time prices stabilize and confidence returns, ownership has already shifted. The market does not announce when this process is complete, it only reveals it after prices begin to rise. The hook is direct. If you wait for certainty, you arrive after the transfer is done. What makes this dynamic especially effective is time. Institutions are willing to sit through extended periods of stagnation because their thesis is based on structural demand, not short-term validation. Retail investors, however, often interpret sideways or declining prices as failure. That mismatch in time preference fuels the transfer. The market rewards those who can endure discomfort longer than others. In suppression phases, patience becomes capital, and emotional resilience becomes strategy. The real lesson is not about predicting the bottom, but about understanding who is being forced to act and who is calmly waiting to receive what they give up. When premiums rise above spot prices, the market is sending a signal that cannot be faked for long. Premium pricing is not driven by speculation or sentiment, it is driven by availability. If silver were truly abundant, buyers would refuse to pay extra and sellers would compete to undercut each other. Instead, when premiums expand, it reveals stress beneath the surface, stress that paper markets are unable or unwilling to show. The hook is immediate and powerful. Scarcity does not announce itself through headlines. It reveals itself through what buyers are forced to pay. Spot prices are theoretical references shaped by futures contracts and leveraged trading, while premiums reflect real-world friction. They account for refining capacity, transportation, storage, delivery timelines, and inventory constraints. When these factors tighten, physical silver becomes more valuable than its quoted price. Buyers who need immediate access cannot wait for contracts to settle or supply chains to normalize. They pay more not because they want to, but because they must. The hook is uncomfortable for many investors. The real price is often higher than the one displayed on the screen. This premium behavior exposes a disconnect between financial abstraction and economic reality. Paper markets assume infinite flexibility. Contracts can be rolled, settled in cash, or offset. Physical markets have no such luxury. An ounce promised is not an ounce delivered. When delivery timelines stretch and inventories thin, premiums rise as a rationing mechanism. This is how markets quietly signal shortage without triggering panic. The hook here is subtle but critical. Shortages rarely appear as empty shelves first. They appear as higher prices paid by informed buyers. Historically, premium expansion has preceded major repricing events. Before markets officially recognize scarcity, those closest to supply chains already feel it. Industrial users, sovereign buyers, and large wholesalers respond early because their operations depend on continuity. Retail participants often dismiss premiums as temporary or irrelevant, focusing instead on spot prices. That misinterpretation creates blind spots. When premiums persist, it means supply cannot meet demand at current prices. The hook becomes unavoidable. The market is already repricing silver, just not where most people are looking. Premium pricing also challenges the idea that falling spot prices equal weakening demand. In many cases, demand remains strong or even increases, but it is concentrated among buyers who value certainty over savings. Paying above spot is a rational decision when the cost of not having silver is greater than the cost of acquiring it. This behavior redefines value from speculation to utility. The hook land's hardy assets become most valuable not when they are cheap, but when they are essential. As premiums widen, they quietly transfer power to holders of physical supply. Those who control inventory gain pricing leverage, while those relying on paper exposure remain disconnected from the real market. This divergence cannot last indefinitely. Either premiums collapse through new supply, or spot prices rise to meet reality. In both cases, the signal has already been given. Scarcity speaks softly at first, but it always speaks through price. Short-term price action in financial markets is far less about economics and far more about psychology. Charts move not because value changes instantly, but because human behavior reacts instantly. Fear, greed, and uncertainty compress complex realities into simple decisions, buy or sell. This is why prices can swing violently even when fundamentals remain stable. The hook is disarming. The market feels rational, but it behaves emotionally. In the short run, sentiment dominates because leveraged participants amplify every move. Traders respond to technical levels, headlines, and momentum signals, often reinforcing trends without questioning their origin. Algorithms accelerate this behavior, executing strategies based on patterns rather than purpose. The result is a feedback loop where price validates emotion and emotion validates price. None of this requires a change in supply or demand. The hook is revealing markets can move dramatically without learning anything new. Fundamentals operate on a different timeline. Industrial demand, monetary policy shifts, production capacity, and reserve accumulation evolve slowly. They are structural forces, not triggers. When prices fall sharply despite stable or rising demand, it reflects a temporary imbalance between perception and reality. Those who focus exclusively on short-term movements often mistake volatility for information. The hook here is critical. Not every move is a message, and not every drop is a warning. This gap between psychology and fundamentals creates opportunity, but only for those who can separate noise from signal. Long-term value investors watch behavior rather than headlines. They observe who is selling, who is buying, and under what conditions. Panic selling by leveraged players carries less informational weight than steady accumulation by entities with long horizons. The hook is uncomfortable. The loudest voices in the market are often the least informed. Market psychology also explains why corrections feel worse than they are. Loss aversion makes declines more emotionally intense than equivalent gains. A 10% drop feels catastrophic, even if it merely retraces previous excess. This emotional asymmetry leads to poor timing decisions, especially when reinforced by media narratives designed to capture attention. Fundamentals do not change at the speed of emotion, but decisions do. The hook becomes personal. The biggest risk in investing is not volatility, it is reaction. Over time, fundamentals reassert control because physical reality cannot be ignored indefinitely. Demand must be met, supply must be sourced, and imbalances must be resolved. When sentiment-driven moves push prices too far from value, correction becomes inevitable. This does not happen on a schedule, which frustrates those seeking immediate validation. Patience becomes the competitive advantage. The market eventually rewards alignment with reality, not alignment with feeling. The enduring truth is that while psychology drives prices in the short term, fundamentals decide where they can stay. So remember this lesson: crashes on the screen do not mean crashes in reality. The Ghost Week trap is designed to shake belief, not value. If you train your mind to look beyond headlines and into behavior, you stop being hunted by the market and you start hunting opportunity. Silver is not crashing, it is being tested. And only those who stay calm, informed, and focused will understand what happens next.